I think that maybe the salient point, which is interesting, is yesterday it came out that Vanguard is our biggest shareholder, 20 million shares of MSTR. And of course, Vanguard, it illustrates a lot of points. First of all, the CEO and the management team of Vanguard doesn't embrace crypto and doesn't embrace Bitcoin at all. But it doesn't matter what they think because the funds they run are passively investing in this, whether they like it or not.
When the world's second largest asset manager becomes your biggest shareholder, everyone pays attention. Vanguard, managing over $9 trillion, has long resisted crypto, with its CEO calling Bitcoin incompatible with its long-term strategy. Yet ironically, Vanguard now holds massive Bitcoin exposure, not directly, but through its huge stake in MicroStrategy, a company that functions more like a Bitcoin ETF than a traditional software firm. Without intending to, Vanguard is effectively buying Bitcoin every day, showing how Bitcoin's growth is becoming inevitable. At the heart of this shift is MicroStrategy's executive chairman, Michael Saylor, whose company holds over 226,000 Bitcoin. Saylor sees Bitcoin as the purest and most secure capital asset ever, and he's turned MicroStrategy into a Trojan horse, attracting billions from markets that might never invest in crypto otherwise. Bitcoin is now competing directly with the S&P 500 as a global index, and companies holding Bitcoin treasuries are pulling in capital while traditional firms lose it. In this video, you'll hear Saylor explain why Bitcoin is growing slower but stronger, driven by structure rather than speculation. With Vanguard caught in passive flows buying Bitcoin daily, this institutional adoption flywheel is in full motion. If you want to understand Bitcoin's path to long-term dominance, this conversation is essential. Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
Yeah, well, I mean, you can look at the history, right? Bitcoin's been decelerating from 120% a year growth to 100% growth to 80%. It was clocking at 80, 90% when I got into it. It's been about 55 to 60% for the past 5 years. If you look at the rate, my forecast is it decelerates from 55% ARR down to 20% ARR over 20 years. Why is it decelerating? Well, obviously for the law of large numbers, when you've got a $100 trillion asset, you're not going to grow 80% at that level. It's decelerating because it's merging with the capital markets, and as it merges with the capital markets, then there's less and less money. It's harder. It's harder. I mean, anybody knows $1 million company can grow faster than $1 billion company, which can grow faster than a $10 billion company, which can grow faster than a $100 billion company, which can grow faster than a $1 trillion company, which can go faster than a $10 trillion company, which can grow faster than a $100 trillion company, right? Not complicated. It's simply the law of large numbers and math. The 20% target is, if I look at it, if you want a bucket of the most high quality scarce capital in the world before Bitcoin was the S&P index. It's basically equity capital that's managed, via buybacks in order to stay reasonably scarce. And you know what that benchmark is. It's been about 10% a year for 100 years. Mm-hmm. Right? So what are you going to get from the S&P? 10 to 12%, 10, 13. The actual amount's going to be a function of the growth and in the equity plus the expansion in the money supply. I think that Bitcoin will outperform the S&P index. And I think it's very simple as to why it will outperform the S&P index. It doesn't have the counterparty risk of corporate structures. And it doesn't have currency exposure, right? So the S&P is saddled with a huge amount of corporate risk factors, dozens and dozens of them, tariff, supply chain, etc. It's got legal risk, it's got political risk, it's got physical risk. I have warehouses, I have nexus, I have an operation in Ukraine, I have, natural gas facilities in Iran, right? There are a lot of things in the real world that constitute risks in the S&P. If I strip away the physical risk, and if I strip away the political risk, and if I strip away the management risk, and then every company takes in cash flows and pesos and naira and euros and CNY and rubles and dollars and Canadian currency and AUD and whatever. So when you strip away all of those risk factors and keep the pure capital, you've got Bitcoin. So whatever those things are, Bitcoin will be more than that. How much more? Or like what is the cost of that? 6 to 8% a year. So if you're targeting the S&P at 12, you target Bitcoin at 18 to 20. Why will it be 18 to 20? I stripped away the risk factors. I also stripped away the constraints. For example, you cannot go long 50x on Apple stock on Sunday morning in Iran, right? You can't, right? We could talk about why you can't, but you just can't. So you can't go long and you cannot short an equity 20x on Sunday morning. So you have all of these guardrails on equity, and they limit the leverage, they limit the utility. If I had pure capital and I could have unlimited leverage, unlimited utility anywhere in the world, 24/7, 365, there are no holidays for Bitcoin, right? So what happens on a bank holiday to a security that you should short or you should go long? Well, you can't. Okay, so that bucket, that benchmark, which is the S&P, it's less volatile, it is less liquid, it is less useful, it is more risky, it is more diversified, and it's got some human factors in it too. I mean, the S&P board just decides what to put in it, right? Like maybe they don't put the right thing in, maybe they leave something that shouldn't be in it, right? So if you're looking for a pure objective monetary index governed by the laws of nature, the most useful type of capital asset in the world to everyone under all circumstances at all times, that's Bitcoin. If I were to say it ought to be twice as performant as the next best thing, that wouldn't be unreasonable. My forecast is it's probably 50% better, maybe 60, 70% better than the next best thing. So my long-term forecast is like 21% ARR and 21 vol. And I would say, the S&P will be more like 10% ARR, 15 vol. Bitcoin's going to have the higher Sharpe ratio. Bitcoin's going to have the higher vol. Bitcoin's going to have the higher performance because it's engineered and it's accessible. There's going to be someone in a country doing something with capital that you don't understand, that's illegal in your country, that's going to make you money, right? Right? The redneck in Arkansas with Bitcoin buried in their backyard is going to make money off of some rocket scientist in Singapore or Beijing doing something with some capital they've never heard of in a way they can't understand, that's either illegal, and they'll be doing it while the guy in Arkansas is sleeping. But the dude in Arkansas is making money. So this is the highest common denominator. Whereas, an American company that owns stuff in Arkansas is not getting its value increased by some Chinese actor, right? Or some, there's no nation state central banker that's going to do something to enhance your Arkansas strip mall or your whatever best idea. So That is the basis of my assumptions about the long-term performance of Bitcoin. Obviously, it's all driven by some base rate assumptions. One base rate assumption is how fast does the money supply expand? Another base rate assumption is how rapidly does technology improve and how much productivity is driven by technology. And if you're bearish on technology and if you believe inflation is going away, then you would probably have a lower estimate than me.
Michael Saylor's forecast for Bitcoin is based on hard numbers and a clear understanding of how capital behaves as markets mature. Bitcoin's growth may have slowed from its early triple-digit surge, but it's still outperforming nearly every traditional asset. As it integrates with global capital markets, its growth shifts from hype to institutional momentum. Saylor estimates Bitcoin will deliver a long-term annual return of 21%, nearly double the S&P 500's average. Unlike equities, Bitcoin carries no management, geopolitical, or supply chain risk. It's pure, liquid capital with no counterparty or political exposure. What sets Bitcoin apart further is its accessibility and flexibility. Unlike stocks, Bitcoin can be traded 24/7, even with high leverage, from anywhere in the world. That makes it not just better capital, but a new kind of capital entirely, open, global, and built for utility. To Saylor, Bitcoin isn't just outperforming stocks, it's outperforming the very idea of them. This leads to the gateway effect. As companies like MicroStrategy, holding massive amounts of Bitcoin, attract passive investment, Bitcoin exposure flows quietly into trillions of dollars worth of index funds and retirement portfolios. In the next segment, Saylor explains how MicroStrategy could join the S&P 500 and why this quiet adoption is only just beginning.
The whole premise of John Bogle and the Vanguard 500 was human decision-making is inadequate compared to the market and will generally be, the market is smarter than any individual's opinion anyway. So passive investing outperforms active investing most of the time, and Vanguard has lots of large passive funds. And once you understand that, you realize the core premise of a Bitcoin treasury company is we're driving Bitcoin adoption by capturing equity investors who can never by mandate buy a commodity. I mean, in our last presentation, we showed $35 trillion of discretionary capital for equity investors versus $700 billion of discretionary capital to invest in commodities, right? So that's 50x as much. So 50x as much capital can flow that way. Then Bitcoin treasury companies are creating an on-ramp for credit investors, right? Because there's $65 trillion of that we showed. So there's even more credit, not quite 100x as much, but 95 times as much capital to buy credit instruments as opposed to commodities. And then this Vanguard example, which is also the S&P example, is there's a set of investors that just park their capital in index funds. They don't make a decision. It's all passive capital. Passive capital locked up in the S&P or the NASDAQ 100 or the MSCI index or total stock market indexes. They can never buy the commodity. They can never buy Bitcoin. They can never buy silver, gold, or palladium. Doesn't matter how good it is. You could record 18 million hours of Bitcoin podcast. You could give away the Bitcoin for free. They're still never going to buy it, right? Because they can't. Because the capital markets in the world are structured. So we're benefiting from passive flows. We're benefiting from active equity investors. We're benefiting from active credit investors. And we're benefiting from, this, I can't even name all the different types of capital that are locked up. The retirement accounts in the UK where you have control of the money, but you can only invest the money in a compliant equity that the retirement account lets you invest in. So there's lots of that, 401ks, IRAs, retirement accounts. They've got them all over the place. They've got them in Australia. They've got them in Japan. They've got them in the UK. And we're creating these instruments, whether they're equity or they're credit, to tap into those pools of capital. And it seems inevitable that passive capital will definitely drive this movement. The one thing that's worthwhile to note about Bitcoin treasury companies that's not true of other equities is Bitcoin treasury companies are pure energy creatures. We're absorbing capital every single day in the market. So if you're looking at my enterprise value, it's like tipping to 140 billion right now. The enterprise value of the company is 1.2 billion 4.5, 5 years ago. So if you were a passive investor, you might have had 1 billion of it. But of course, as we get 100x bigger, you're buying 100x more, and we're qualifying for a lot more indexes. And as we get indexed, that means that, when there are passive flows, and there are always passive flows, on the margin, there's always going to be more euros and more dollars flowing into passive capital markets funds. That's going to flow into the Bitcoin treasury companies and the index. And when that flows, it's going to drive their premium. And when the premium expands, then they can simply issue the equity, buy the Bitcoin, expand their equity market cap, expand their weighting in the indexes, rinse and repeat. And so BTC companies are positively polarized to the capital. They're magnetically attracting it. And I can't help but be amused by the fact that every major successful bank is upping their dividend and they're upping their buybacks. So they're surrendering capital to decrease their equity market cap. And then every well-run tech company is buying back their stock and issuing dividends to decrease their weighting in the indexes. So every well-run company running a traditional corporate finance playbook is surrendering capital as rapidly as they can. In fact, the more successful they are, the faster they surrender the capital, and the more they diminish their weighting in the passive funds. And then every BTC company is attracting capital, increasing their weighting in these funds, and thereby increasing their credit and equity premiums to the underlying assets, which is beneficial to all their investors. So there's a very positive cycle going on for Bitcoin treasury companies, and there's a very negative capital cycle going on for companies capitalized on traditional credit instruments.
What Michael Saylor presents isn't just a case for Bitcoin, it's a roadmap for the future of capital. In a world dominated by passive flows and constrained by traditional finance, Bitcoin stands out as an asset built to operate in any market, any time zone, under any regime. While Wall Street holds onto legacy benchmarks like the S&P 500, the most forward-looking capital is shifting toward an asset that never sleeps, never inflates, and never asks permission. Vanguard's massive stake in MicroStrategy, despite its public rejection of crypto, is the ultimate irony and the ultimate validation. Passive capital doesn't follow opinions, it follows structure. And that structure is starting to favor Bitcoin. Saylor's strategy is simple yet powerful. Use MicroStrategy as a public vehicle to convert equity into Bitcoin, increase shareholder value, and qualify for broader index inclusion, creating a self-reinforcing cycle. Meanwhile, traditional companies are shrinking, paying dividends, and reducing their index weightings. In contrast, Bitcoin treasury companies are growing rapidly, attracting passive equity, credit, retirement funds, and even sovereign wealth. This isn't just price speculation, it's a deep structural shift in global finance. And the macro environment is only fueling this shift. With the Fed expected to cut rates and the ECB already easing, liquidity is returning, and Bitcoin has historically been the first asset to respond. On-chain data shows a surge in institutional accumulation and dormant wallet activity, signaling smart money is preparing for the next bull run. Whether you're holding Bitcoin directly, investing in firms like MicroStrategy, or just observing, one thing is clear. Bitcoin is becoming the default destination for global capital. The convergence of tech, monetary policy, and passive flows is creating something unstoppable. The only question is, are you ready? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.